Most people saw silver jump 7% on April 1st and just scrolled past it. But what actually happened that day, the real reason behind that move, could be the beginning of something that sends silver back toward $100 faster than anyone is expecting. And if you do not understand what is driving this right now, you might be the last person to find out. Stay with me, because I am going to break this down in a way that actually makes sense. No jargon, no noise, just the real story. Let me start simple. Forget the numbers for a second. Here is what you need to know first. Silver has been on one of the most extraordinary rides of any asset in modern history. It went up 147% in 2025 alone. Then in January of this year, it hit an all-time high. Then it got absolutely crushed. In March, it fell nearly 16% in a matter of weeks. The mainstream financial press started writing headlines about the silver rally being over, about the bubble popping, about investors moving on, and then April 1st happened. Silver exploded 7% in a single trading session. The next day, another 3.5% on top of that. In 2 days, silver went from looking defeated to looking like it never left, and the financial press, they gave it 3 sentences. Technical buying, dollar weakness, moving on. That is not an explanation. That is a cover story. And right now, before I go any further, if you want real analysis like this, not what the media feeds you, hit subscribe and the like button right now, because what is coming next in the silver market is something most people will not see until it is already happening. Subscribe now, and I will make sure you are not one of them. Let's go. To understand what really happened on April 1st, we need to go back to March, when silver got absolutely crushed. Look at this carefully. Silver spent the entire month of March bleeding out. Week after week, the price kept sliding lower. Short sellers, people who were betting the price would fall, were piling in. Every day that silver dropped, they made money. Their positions grew, their confidence grew, and by the end of March, there was a massive pile of short bets sitting on top of silver, all of those traders expecting it to keep falling. Here is what nobody explains properly. That situation is like a loaded spring. The more short sellers pile in, the more explosive the snapback becomes when something finally reverses the trend, because every single one of those short sellers eventually has to buy to close their position, and when they all do it at the same time, when something triggers a reversal, you do not get a normal 2% move. You get 7% in a single day. That is not technical buying. That is a trap closing on a room full of short sellers simultaneously, and that is what happened on April 1st. But here is where things get really serious. The short squeeze only explains the size of the move. It does not explain why silver reversed at all. For that, you need to look at what happened in the world that day. The geopolitical situation with Iran had been brutal for precious metals through most of March. The US-Iran conflict, which began escalating in late 2025, had pushed oil above $100 a barrel. High oil prices meant higher inflation fears. Higher inflation fears meant the Fed might have to keep rates high or even raise them, and higher rates mean holding gold and silver assets that pay no interest becomes more expensive. Capital was fleeing precious metals through most of March because the macro environment was working against them. Then the signal came. Trump showed readiness for peace. Ceasefire signals emerged. Watch what happens next. Oil dropped sharply from near $120 a barrel down toward the low 80s. And when oil fell, inflation fears eased. And when inflation fears eased, the dollar weakened. A weaker dollar means commodities priced in dollars get cheaper for international buyers. Asian buyers, Indian buyers, European buyers, they all got a price cut on silver at the exact same moment, and they stepped in hard. That wave of fresh international buying, arriving at the same time that a room full of short sellers was scrambling to cover their positions, created the perfect conditions for a 7% explosion. Now here is the part that nobody is talking about, and this changes everything. That 7% move did not happen in a vacuum. It happened on top of a foundation that has been building for 6 years straight. Go back and look at this number. The global silver market has run a structural supply deficit for 6 consecutive years. In a row, 6 years where the world consumed more silver than it mined and recycled, and the Silver Institute confirmed just a few weeks ago that 2026 is on track to be the 6th year of deficit. Think about what that means physically. Above ground silver stockpiles, the metal sitting in exchange vaults, in ETF holdings, in industrial inventory have been drained year after year after year. The COMEX registered silver inventory, the pile of silver specifically available for delivery in New York, fell 31% in just a few months going into this year. In 7 trading days in January alone, over 33 million ounces were physically pulled out of COMEX vaults for delivery. That is 26% of the entire registered inventory disappearing in a single week. Here is something that should make your jaw drop. The paper silver market, the futures contracts trading on COMEX, represents over 500 million ounces of silver exposure in a single contract month. The actual deliverable physical silver backing those contracts? About 113 million ounces. That means there are more than 4 paper claims on silver for every single real ounce that could actually be delivered, for 2-1. Some analysts put the overall paper to physical ratio even higher, around 300-1 across the whole market. This is what nobody is telling you. This is the real story underneath every single price move in silver. You have a paper system that has been creating claims on silver for decades, and a physical market that has been running a deficit for 6 years, and above ground stockpiles that keep shrinking every time silver gets sold down. Hard in the paper market like it did in March, the physical buyers at the bottom get a gift. They buy real metal at artificially suppressed paper prices, and then when the paper market snaps back, it has to play catch up with reality. Now let's talk about the industrial side, because this is the floor that never goes away regardless of what the paper market does. Here is what happened during March's brutal correction. Solar panel factories did not stop using silver. EV manufacturers did not stop putting silver contacts in their battery management systems. AI data center builders did not stop requiring silver for their thermal management systems. BlackRock noted that about 60% of annual silver consumption is tied to electronics, solar panels, and semiconductors, roughly 445 million ounces of demand per year. None of that stopped because the paper price dropped 16%. Industrial buyers need the physical metal, they buy it, they provide a floor that catches silver every time the paper market overshoots. And that floor was sitting right there when April 1st arrived. Industrial buyers had been loading up on physical silver through the March correction, taking advantage of suppressed paper prices to stock their inventory when the geopolitical trigger hit and the dollar weakened and the short sellers started covering the industrial buying floor and the short covering snapback all came together in a single session. Now here is something that the financial press has almost completely ignored, and I want you to pay close attention here because this is where the future of silver gets genuinely interesting. Russia made history quietly in early 2026 by becoming the first major central bank in the modern era to formally accumulate silver as a reserve asset, not gold. Silver, central banks have been buying gold at record rates for 3 years, over 1,000 tons annually in 2022, 2023, and 2024. Because of de-dollarization. When the West froze $300 billion in Russian reserves after Ukraine, every central bank outside the Western alliance got the message. Dollar reserves can be weaponized, gold cannot. It sits in your vault and no foreign government can touch it. Now a major central bank is applying that same logic to silver. Silver cannot be sanctioned or frozen, and at current price levels it is still relatively accessible compared to gold. If even a handful of sovereign funds follow Russia's lead, the demand implications would be transformative for a market already in its 6th consecutive deficit year. This is not hypothetical, it is already happening, and the mainstream press is not connecting these dots for you. Let's talk about where silver goes from here, and I want to be honest with you, not just bullish. JP Morgan forecasts silver averaging $81 in 2026, more than double its 2025 average. Goldman Sachs holds a $5,400 year-end target for gold. UBS has gold at $6,200 with a $7,200 upside scenario when gold reaches those levels. And the gold-to-silver ratio normalizes toward historical averages. The math for silver well above $100 becomes straightforward. But here is the honest part. Silver is the most volatile of the major precious metals. It has a history of explosive moves in both directions. The paper market can still manufacture heavy pressure when it needs to. Margin hikes can flush out leveraged longs. If the Iran situation escalates rather than resolves, oil spikes again, inflation fears return, the dollar strengthens, and silver could face headwinds again in the near term. Anyone who tells you silver only goes up in a straight line is not being honest with you. This market rewards patience and understanding more than it rewards short-term trading. Now let me take you one layer deeper, because this is where the story gets genuinely uncomfortable for the people who have been comfortable dismissing silver as just a speculative trade. Go back and look at what happened at COMEX during the first weeks of 2026. The COMEX has 2 categories of silver inventory: eligible metal silver sitting in approved vaults belonging to its owner, not available for exchange delivery, and registered metal silver specifically certified for delivery against futures contracts. Registered is the pile the exchange can actually draw on when traders demand physical delivery instead of cash. For decades, the whole paper market operated on one critical assumption. Nobody would demand delivery in large quantities all at once. Traders would roll contracts forward, take cash settlement, and walk away. The registered inventory did not need to match the paper contracts because nobody was calling the bluff. In early 2026, that assumption broke down. In a single week in January, 26% of COMEX registered inventory was pulled out for physical delivery in 7 days. These were not industrial users. They were institutional investors, big money, making a very specific statement. They wanted the bar, not the paper. Promise. When that happens at that scale, you are watching the beginning of a crisis of confidence in the paper-silver pricing system. And once that confidence starts cracking, every subsequent paper sell-down becomes a gift to physical buyers, which is exactly what made the March correction look less like a bear market and more like a clearing event. Now think about Shanghai, because this story runs completely parallel and the mainstream press barely notices it. Shanghai physical silver has been consistently more expensive than COMEX paper silver for months, at various points trading at $10, $12, even $15 premiums. Under normal conditions, that spread would be arbitraged away within days. Traders would buy cheap COMEX silver, ship it to Shanghai, and pocket the difference. In a healthy liquid market, this happens automatically. Look at this carefully. The spread has not consistently closed. The arbitrage is not working. The reason is simple: there is not enough physical silver that can actually be moved to close the gap. China tightened its export controls in 2026, requiring state approval and restricting which companies can export. China controls Between 60 and 70% of the world's refined silver supply. When China restricts exports, the global physical pool shrinks. The silver is still there, it is just in China, and it is staying in China. China is the world's largest solar panel manufacturer, the largest TV producer, and has formally classified silver as a strategic material. It is keeping its silver. Right now in 2026, silver is effectively trading into completely different markets simultaneously. There is the paper market COMEX futures, ETFs, derivatives, contracts. This is where the quoted price comes from, and this market can be moved by a relatively small number of large traders using leverage when they want. To push the price down, they can. Margin hikes help, dollar strength helps. This is why March happened. And then there is the physical market, real bars changing hands between real buyers who need actual metal for actual purposes. This market responds to supply and demand, not paper contracts, and right now in the physical market, demand consistently exceeds supply. The 6-year structural deficit is a physical fact. The 31% COMEX inventory drawdown is a physical fact. The Shanghai premiums that refuse to close are a physical fact. When these two markets diverge, when the paper price drops below where physical buyers are willing to transact, you get a tension that eventually resolves. Paper cannot indefinitely price a commodity below its physical clearing price when real buyers keep showing up and taking delivery, draining the inventory that the paper market needs to function. At some point, the paper price has to reflect physical reality. The paper market tries to suppress the price, the physical buyers absorb every ounce available at suppressed prices, and then the spring releases 7% in a day. This is the cycle. What April 2026 is telling you is that the rubber band stretched very far in March and snapped back on April 1st. The question is not whether the fundamentals are bullish, they clearly are. The question is how much paper market volatility you live through on the way to the price reflecting those fundamentals, and the answer is that it rewards people who understand the structure over people reading 3-sentence news summaries. The next time silver moves 5% or 7% in a day, most people will panic. They will sell in fear or by in excitement without understanding why, but not you. Not anymore. Because now you understand the difference between the paper market and the physical market, you understand the 6-year structural deficit, you understand the short covering dynamics, you understand the industrial demand floor, you understand why sovereign institutions are starting to treat silver as a strategic asset, and you understand that the 7% move on April 1st was not random noise. The next time silver moves, and it will, you will not be panicking. You will be the one who already knows what is happening, and that is where the opportunity is. If this video gave you something real, a picture of what is actually happening that 3 sentences of mainstream coverage completely missed, drop a comment right now. Tell me where you think silver goes from here. Are you holding? Did you buy the March dip? Are we headed back to 100? I read every comment and your thoughts directly shape what I research next. And if you know someone watching silver or thinking about their portfolio, share this video right now. 2 seconds, real analysis in front of people who deserve it. Thanks for being here. The silver story in 2026 is far from over.